Debt to capital. This is looking at how much debt we hold in our business relative to the entire capital structure that we have. We're going to break down those two terms now. Firstly, the calculation for debt to capital is the debt you hold within the business divided by your debt plus your equity. That then gives you your debt to capital calculation. I used the fancy word a moment ago as to how you're structured, how your capital is structured within your business. How reliant are you on debt relative to the entire funding of your business? Let's use that example I used previously on debt to equity. If I buy a truck to start my business and I'm assuming I own no other assets, have no other liabilities, and I have no equity, I'm at ground zero. I buy a truck for $250,000, that's my asset. I have debt of $250,000 to buy that truck, and I have $0 equity because my assets match my liabilities, which gives me $0 equity. In this case, my entire capital structure is driven by debt. I would be 100% debt of my capital. The calculation would be $250,000 worth of debt divided by my debt plus my equity, which also equals $250,000. It's a zero. Therefore, my total structure is 100% debt versus equity. As your business grows, hopefully, the gap between those two numbers becomes greater. What's a good number for debt to capital? As I've said in previous videos, debt is a very personal thing. I know some people who are very stressed having a low amount of debt, and I know some people who appear to have no stress with a very high amount of debt. But I would say to have an efficient capital structure, you want to have it somewhere between 40 to 60%. 60% is probably the upper limits of where I'd want it to be, but it's also relative to the returns you're getting within your business. If you're getting great returns, and you believe you can continue to get those returns, then debt suddenly doesn't appear as risky. Conversely, if you're losing money, you could have a debt level that's only at 30%, and that could be at a very stressful place to be. How to influence this number? Very similar to what we've spoken about previously on debt to equity. Is the best way to improve this is to improve the equity, improve the returns on your business. The greatest way to pay down debt and to reduce the risk of debt is to enhance your operations and enhance your profitability of what you're achieving. If we go back to that truck example, if that truck is helping significantly boost the profits of the business, then that is going to help with the equity, and that's going to help reduce that debt over time quickly, and our equity is going to start to dwarf our debt position. Conversely, if we're losing money, that debt is going to look like a mountain relative to what we have within our business at an equity level.